How's everyone doing this afternoon? You are in the strategy room with the banker next door, your host here for a couple hours of action and adventure. Well, maybe not so much the action adventure, but we're going to try. We're going to try, right? So this is Sunday, August 2nd, 2026. Usually we are on Saturday night. I was actually not feeling so hot last night, so I tried to move it to this morning, and then I was gonna do, some stuff this morning, and then anyway, it got all messed up. So here we are on a Sunday afternoon doing the regular live stream, and I have a ton of stuff. Even though we are in the dog days of summer, as it were, we had a lot of stuff that happened this week. FOMC meeting. Even though Kevin Warsh, the FOMC, they did not change interest rates. We had three dissenting votes, and we also had a narrative. I'm going to put it that way. We had a narrative in the market around interest rates, basically saying that, hey, the bond market, expected an interest rate increase, and they did not get that, and that's why the bond market reacted the way it did. I have some alternative theories on why the bond market is currently acting the way it is, and it has a lot to do with a lot of the conversation that we have been having on this live stream for pretty much the better part of the last year. It's around the national debt, the AI trade, a lot of different things at play in there, as not just the interest rates. There's also this crazy story about situational awareness, this hedge fund that was run by this 25-year-old, which basically crashed and burned spectacularly this week. So we're going to get into that, and we're going to get into that right away, because that really ties in to the narrative on a lot of the Fed conversation, the interest rate conversation, the bond market conversation. And then we're going to get into the AI conversation. We had a lot of earnings this week: Meta, Amazon, Google, Microsoft. Looking at all of their earnings as they came out this week. So we're going to take a look at all that. What does that mean to basically the AI trade itself, the spending that has been put out there on AI? I've been saying for months and months and months that the capex, i.e. the spending on the AI trade and data centers and infrastructure, has just completely gone off the rails. I mean, completely out of sight with the spending. I have a feeling that a lot of that is going to be coming back down to earth. Also, on the AI conversation front, we had some crazy things that happened in this last week with Anthropic's Claude AI hacking some systems, OpenAI's system, this Hugging something or whatever, we'll get into it, but just going around the internet and coming back in and hacking back in. So we're going to get into all that, talk about all that. I've got on the back end, I've got some Robinhood news. Got a little bit of Epstein update with the Goldman Sachs attorney, and then I've got some things I want to talk about with the auto industry. Kind of a very interesting auto industry update, but also ties into some of the AI things going on as well. So got a lot rolling here in the show today. So just get strapped in and ready to go. And like I said, we're gonna do this for a couple hours here this afternoon. I'll get you out of here before midnight. All right, maybe not that long, but a little while. All right, let's kick off as we usually do, looking at the U.S. debt clock. As you can see here in the upper left-hand corner, we are getting dangerously close to hitting that $40 trillion mark. We are basically at $39.7 trillion. That equates to a debt per taxpayer of $115,000 and a debt per citizen. And then we have the debt per taxpayer of $358,000. U.S. federal spending is still at $7.2 trillion, with the U.S. federal budget deficit at $1.6 trillion to the negative. The debt to GDP, and again, that's federal debt to GDP, is at 122, almost 123%. Credit card debt is at 1.3 trillion. That equates to a per cardholder debt of $8,365. Interest on the national debt, as you can see here, is now up over $1.1 trillion. And where the bond market just went this week, and with our federal debt here getting ready to go over 40 trillion, you're going to be looking at almost, and it's almost insane to say this, you're going to be looking at almost $2 trillion in interest just to service the national debt. That's just just wild, just completely and totally beyond belief. But that's what we're looking at for next year. If so, I mean, something has to be done about the spending. I mean, seriously done about the spending. I mean, some kind of plan has to be put forward. I think one of the best things that Republicans could do before the midterms, like, as soon as they come back in September, somebody better come out with a plan for how they're going to at least attempt to tackle this. At least, some attempt at, like, okay, here's what we think we can do to get the budget. At least let's try balancing the budget first. Let's try stop, adding to the national debt. And then how can we get this paid down? Like, what can we do here? I think there are a number of things that they can do to tackle this. But I think that obviously that would go a long way with trying to calm the bond market down and addressing what a lot of voters want, and they want something done about this. So, all right, so but I don't know. We'll see. We'll see what happens with that. So that's where we stand with the debt picture. Now let's go in and take a look. So stocks were a little mixed this week, a little choppy up and down. But the big thing here, I want to take a look at commodities here for just a second. So the crude oil futures and the Brent crude futures. Now we can see here in our chart right here to the right, big spike here in just the last, I mean, not even 24 hours, but a huge spike here going up from 84 to 86, almost $87 a barrel right here for crude oil futures. Now we did just get news not too long ago. I was just looking at some stuff or just an hour ago, and again, the president is out there. President Trump is out there basically saying, "Hey, we're gonna sign a peace deal with Iran, and we're gonna get this over." Where have we heard this before? Like, so I'm not holding my breath on any of that. I feel like we've just been down this road too many times in the last few months, and we just need to wait and see what happens. But I just wanted to show you that we had these spike ups here, and the market did not seem to be reassured by the president coming out earlier this morning, basically saying, "Oh yeah, we've got this deal and we're going to work it out." That didn't really seem to assuage the fears in the oil market. So again, crude oil futures right now up at 86, pressing up almost $87 a barrel. The Brent crude futures are over $91 a barrel. Now, and again, this isn't the panic button. This isn't hit the panic button, but this is not where you want it to be. Just to point out a couple other things, gold futures are at $4,098. They have come well off their 12-month high, which was at almost 5,400. So, I mean, down about 1,300, 1,400 points off the high. Silver coming in at 57.75. Again, way off the high there. Silver was in the 80s and 90s earlier this year. So again, that calming right down. Natural gas at $2.79. Again, calming down there. That was in the low threes, earlier this year. So gas prices have calmed down a little bit. So just some interesting things to note there about some other things going on in the market. If we look at cryptos real quick, we could see Bitcoin still sitting here at 63,251. I've talked about Bitcoin a lot. I'm going to be having some crypto episodes coming up real soon. We're going to dive back into some of the things happening in the crypto market. Crypto legislation still, going back and forth. Not too much of an update with that as the Senate continues to squabble over a couple of things there. So again, still kind of waiting for the logjam to break with that, if you will. And again, that's primarily around the Clarity Act. The Genius Act has already been passed into law. We're waiting for them to get through with the Clarity Act. So, and let's see, is there anything else I want to point out? Okay, now to interest rates. So the really bad thing, one of the things I talked about last week that I had this great article on was the 30-year bond. I wanted to talk about why the 30-year bond was so important. And we are at a high in the 30-year bond at 5.28%. And I explained last week why the 30-year bond, that 5% rate is such a key psychological barrier there, why going over 5% it just signals a very bad thing. I mean, we have not been here since going back to the financial crisis back in '07. That's how long it's been since the 30-year bond was up over 5%. So it's not, again, it's not a good indicator. But what does, at the end of the day, what does the 30-year bond ultimately tell you? What it tells you is that it's a sentiment, if you will, a sentiment about the overall market by the bond market. The bond market is telling you that they have big concerns, particularly around the national debt and the country's ability to repay said debt, repay said bond debt, say said treasuries. That is really what it's telling you. And again, and this is why we go back to our chart. This is why I show you the chart every week and why we say, okay, we're pressing up on almost $40 trillion here, because that is the real concern of the market. That's what's happening there. Now, the 10-year note is reacting, I think, on a combination of things. And again, we saw the 10-year explode up to 4.74% this week. I mean, basically all the rates jumped up. 7-year note jumped up to 4.59. The 5-year note jumped up to 4.45. The 3-year note jumped up to 4.38. The 2-year note jumped up to 4.3. The 1 year is at basically 4%. 6-month is at 3.9. The 3-month is at 3.7, and the 1 month is at 3.6. But I mean, basically the bad news is that all this stuff has jumped up. We'll see here in just a second how the 30-year mortgage that got pressed up to the highest that's been in like a year here. So again, not good. None of this is good. None of this is heading in the direction we want it to. Now, what we're going to see here in a few minutes when we get into the Fed conversation, everything else, is what is very interesting to note is the narrative. I was paying very close attention to the narrative this week, and what you got after the Fed decision was a narrative of, oh, well, the bond market's going up, interest rates are getting pushed up. This is all a reaction to the Fed not doing anything. And yes, and I will say the Fed's decision played into this, but was the Fed's decision the main driver of this? No, I don't believe that the Fed's decision, whether, to stand pat, I don't believe that that was a real driver of this. I believe the potential escalation in the conflict in Iran, I think that was a bigger issue. I think the meltdown of situational awareness was a big issue. I think some of the games that Citadel was playing in the market were a major issue. I think the national debt becoming, getting more and more attention. I think that is becoming an issue. I think all of those things are basically in the stew, baking together. But to say that the Fed's decision to stand pat again was the main driver for the interest rates going up, no, I don't believe that to be the case. But that's, like I said, that's what they painted as the narrative, which was very interesting to see. Because, and we'll get into this, again, it's coming back to Kevin Warsh. What is Kevin Warsh going to do as chairman of the Fed? I think if Kevin is going to play, but remember, Jerome Powell is still on the board. He's still on the board of the FOMC there. He's still one of the voting governors. He's the shadow chair hanging out on the side now, influencing things. And I think that basically what, again, I talked about this whole setup here, but I think what you're going to see is if Kevin Warsh is willing to play ball, then Jerome Powell and his cronies over there at the Fed will play nice. But if Kevin Warsh wants to make substantive changes to the Fed, the narrative is going to be negative on Mr. Warsh. It's all going to, you're going to see a whole bunch of articles. Everybody's going to be, oh, we're going to blaming Kevin. It's all his fault. Forget all the terrible policy from Ben Bernanke, Jeremy or Janet Yellen, and Jerome Powell. Forget all the three amigos. Forget all their bad policy over the last over the last 18 years. It's all Kevin, who's been there for a whopping month. So again, we're going to take a look at all that and get into that. But I needed to show this first to paint the picture of where we're at. And that basically is that interest rates have gone up across the board. and the 10-year note in particular is now we're pressing up on a basically 4.75%, and that's not good. That is going in the exact wrong direction. And again, the 30-year bond being at 5.28% should be highly concerning to everybody. It just absolutely should. So, all right, now let's take a look at residential mortgage rates because of this at the moment. Now, these are rates as of today. So, according to rates from Zillow Lender Marketplace, mortgage rates are a bit lower compared to last week. The current 30-year fixed rate fell by 10 basis points to 6.65%. The 15-year fixed rate declined by 3 basis points to 6.01, and the 5/1 arm rose by a single basis point to 6.65. Now, still though, 6.65 is the highest rate that we have seen here in probably the last 12 months, which again is not good considering that at the beginning of the year, we were pressing down at 6%, looking to go even below 6%. To be back up here, definitely disappointing. So, but the 30-year fixed rate at 6.65%, 15-year fixed rate at 6.01, the 5/1 arm at 6.65, and the 30-year VA at 6.11%. Now, let's look at the refinance rates for just a second. So refinance rates maybe just a tad better in a certain respect. So the 30-year fixed rate at 6.57%. 15-year fixed at 6.01%, the 5/1 arm at 6.68%, and the 30-year VA mortgage at 6.16%. So again, just to point out where we are here on interest rates. Now, okay, let's get into this whole situational awareness thing for a second, because I think this is going to kind of set the mood, if you will, or kind of set us on our path here as we go through all the rest of these articles here over the next couple hours. So situational awareness is down 67% in July in AI stock rout. Leopold Aschenbrenner's, that's the kid's name, basically the 24-year-old who started this hedge fund, backed out of a deal to sell 3.5 billion of Anthropic shares. So again, it's kind of funny. The irony is dripping. The fact that this thing was called situational awareness when turns out they weren't very situationally aware. I can't help it. I'm sorry, I can't help it. Okay, but let's hop in here for a second. So Leopold Aschenbrenner's hedge fund situational awareness is down around 67% so far in July after incurring heavy losses on AI stocks, according to a person who saw a letter the firm sent to investors on Thursday. We let you down this month. That's one way to describe it. Aschenbrenner wrote in the investor letter, the content of which were described to the Wall Street Journal. The deep losses prompted the firm to sell the bulk of its stock holdings to Ken Griffin's investment firm Citadel as it raced to gather cash to cover margin calls from its lenders. Situational went so far as to reach a deal late Wednesday to sell $3.5 billion worth of its stake in the privately held AI giant Anthropic to a consortium of investors led by Green Oaks and Sequoia Capital. People familiar with the matter said, but Situational had an apparent change of heart by Thursday morning and backed out, the people said. Situational's gains early in the year were so large that even including July's losses, the fund remains up about 80% on the year, the letter said. Through the end of May, Situational gained about 270%, the journal reported. That's nice, but unfortunately, the overall value has gone from $45 billion to $10 billion. So they've dropped $35 billion in 1 month. So it's nice that their gains are still up technically on the year. This has been a major collapse. Aschenbrenner partially blamed short sellers. Of course, short sellers, always the easy, evil target, who targeted the firm's positions for exacerbating the fund's losses, the letter said. The letter compared Situational's experience to a bank run. Aschenbrenner told investors that the firm had removed all leverage from the portfolio. Representatives for Situational Awareness didn't immediately respond to requests for comments. The firm still holds a portfolio of investments in private companies, including the Anthropic stake. Bloomberg earlier reported that Situational had tried to sell some of its privately held investments. Situational's swings in fortune and the scale of the wagers that drove them embodied the audacious bets Silicon Valley is making on the future, shaping technology and the global AI boom. The fund's July losses and the gains for the year, despite them, are representative of the market turbulence that has kept investors on their toes. Situational has amassed well over 20 billion in assets under management. Yeah, they were up to 45 billion since its founding around 2 years ago, making it one of the fastest growing firms in recent years. Aschenbrenner had no professional investing experience. Let me say that again. They gave $45 billion to a young kid who had zero, not a little, not a little bit, zero investing experience when he started the firm with a few $100 million. He was seen by some as an artificial intelligence oracle. By some. Interesting. By some. With other investors closely tracking the firm's movements as it placed big leveraged bets on AI-related companies. So, yeah, this article was not that great. I felt like they left a lot of key points out. Now we look at this: how Leopold Aschenbrenner built a 45 billion AI hedge fund and lost most of it in days. The former AI researcher Leopold Aschenbrenner's AI hedge fund, Situational Awareness, collapsed from 45 billion to around 10 billion in assets on falling semiconductor stocks and mounting margin calls. Interesting. We call that leverage. Yeah, when you've got a lot of margin debt, that is called leverage, folks. And there's nothing that will kill you faster than being over leveraged. Driven by reported leverage of up to 400%. 400%. The 20-something manager was forced to sell off all his leveraged public stock bets, including hard-hit names like SK Hynix and CoreWeave, to Ken Griffin's Citadel at a discount. The crash marks a dramatic turn for Aschenbrenner, who launched the fund after gaining Silicon Valley fame with his 2024 AI manifesto, drawing scrutiny from critics over his lack of money management experience and his past ties to FTX. So, this young kid has a very interesting resume. He's from Germany, born in Germany. Let me scroll down here. Here's a picture of this young man right here. So he comes from Germany. He goes over to, I think, Colombia at the age of 15 years old. He graduates, I believe, from, again, I think, yeah, Columbia University. He graduated from Columbia University. He was their valedictorian at 19. Pretty wild. Starts college at 15. He graduates at 19 from Columbia University as the valedictorian. Pretty amazing. So, and then he proceeds to go from there to go to work for Sam Bankman-Fried at FTX. Interesting. He was also what is known as an effective altruist. Now, if anybody has followed any of my crypto series, first couple episodes I do on that series are all on the crypto winter of 2022 and Sam Bankman-Fried and FTX. And I talk about how Sam Bankman-Fried and his merry band of followers over there at FTX, they were all effective altruists. I think of this whole concept of effective altruism, I think is just completely stupid. And it goes hand in hand with the whole concept of the book. Do I have? I don't have it sitting here right this second. Suicidal empathy goes right along those same lines. Okay, effective altruism goes right along with suicidal empathy, right in that vein. But anyway, I'm not going to get on a whole tangent of that. I'm just trying to give you a feel for like who this kid was, what his background was, where he came from. So then he goes from FTX and he jumps over to OpenAI with Sam Altman, another super shady character, right? So then he gets fired from OpenAI for basically handing out what they deem kind of like classified company documents. Now, he claimed that he didn't do that. It was just a big misunderstanding. But nevertheless, OpenAI was like, yeah, you're fired, get out. So then this kid, he goes and he writes this manifesto, if you will, on AI. And basically says, yeah, AI said, you know what? yeah, Salesforce seems to be, they're not lighting the world on fire, but they're doing okay. Like they're not going anywhere tomorrow. They're not going to go out of business. All these software companies aren't going out of business tomorrow. You know what? They might have all been down, 30%. You know what? Maybe I'm going to buy back in. And so people started buying back in, stock goes back up, and they take a bath. Basically, the short trade went against them. They take a bath. Now they're long the AI trade. And what happens? Oh, that's right. The AI stocks took a beating for about 2 weeks and just went completely down and sunk him on that trade. So this is what happens, when you make a highly concentrated bet in a portfolio. Like, you've got a hedge fund and you've got $45 billion and you're putting all that money into one trade, the AI trade. And then when that trade goes sideways, you know what happens? Your firm blows up. That's what happens. And the moral of the story here is basically you do not give 25, or you do not give tens of billions of dollars to a 25-year-old kid. That's the moral of the story here at the end of the day. Like, why anybody would do that, I have no idea. I have no idea. It boggles the mind. And again, I'm not saying this kid probably is a genius. He sounds like a genius. Probably is a genius. I think there's something going on there, though. The fact that he jumped from FTX to OpenAI, gets canned by OpenAI, and then and immediately pivots to starting this hedge fund, and now this hedge fund's so something is amiss here with this character. Okay, something is amiss here with this kid's character. I don't have enough information to say like what this, that, or the other thing. I'm just saying that my spidey sense is tingling. Okay, my spidey sense is tingling on this kid, just like it does with Sam Altman and a lot of these other, AI clowns. It just does. It just does. And something is not right here. And again, the moral of the story: please be smarter with your money. Okay, and again, not that the older pros, not that they're always right, or that they they don't get everything right. They're not perfect, but it's a good idea to give your money to somebody that's got some gray hair. That's a good idea. You want somebody who has lived a little while. You want somebody who has life experience, who has seen market cycles, who has seen ups and downs, who is a professional trader, okay, who understands the ins and outs of the market. Now, let's talk, but just for a second here, let's talk about Citadel's role in this whole thing for a second here. Now, because a lot of people were crying foul around Citadel, because Citadel apparently put out this report that the Federal Reserve was going to increase interest rates twice this year, and that they were going to increase interest rates, wait for it, at this month's meeting here in July. So Citadel apparently, I say apparently because I don't know for sure, apparently put out this fake report that basically said, oh yeah, the interest rates are going to go up. And then there was some other perhaps market trades or other things going on there that, again, some people were saying that Citadel partially manipulated this and then swooped in to buy his portfolio up after they had crashed him. Would I put that beyond Citadel to do such a thing? No, absolutely not. Citadel is a shark. They are a flat out shark. I give them their due. They're the biggest, baddest hedge fund probably around at this time. They got a lot of I'd say they got a lot of really good sharp people working over there. But make no mistake about it, they are a shark. They are a shark, and they see this kid coming, and they can't wait. They're going to eat his lunch. That is their goal, is to eat his lunch. So anyway, now, why do I say that? Why does the Citadel aspect of this become important? Well, it leads into our discussion now of what we're going to go into here on the Federal Reserve. It leads into what happened with the Federal Reserve this week, what happened with the bond market, why did interest rates go up, and why was it possible that it wasn't just the Fed's decision that caused interest rates to spike? Maybe maybe it was that Citadel had a little bit to do with that, you know. So again, that's why I wanted to lead with this, and I wanted to talk about this a little bit. Again, crazy story here with this young kid, Leopold Aschenbrenner, basically imploding this $45 billion hedge fund this week. Again, pretty wild. But I am sure that there is going to be more to this story. There's probably more that will come out in the weeks and months ahead, and we'll just have to wait to see what that is. So, okay, before we get into the Fed thing, I just want to run through. I had three other kind of sub stories that were going on this week. So, the Cracker Barrel CEO. So Cracker Barrel names new CEO following the rebranding backlash. David Deno will lead the restaurant chain following the controversial attempt to modernize its image. So Cracker Barrel is replacing CEO Julie Fells Messino following an ill-fated effort to give the Southern-themed restaurant chain a modern look. Messino will step down on August 10th and be succeeded by David Deno, the former CEO of Bloomin' Brands, which owns Outback Steakhouse. She will remain with Cracker Barrel in an advisory role through October 9th to assist with the transition, the company announced on July 27th. Now, what was interesting is that one of Messino's comments was she felt like she was being fired by America. Yes, I think that's very accurate. Yes, I would say that she was fired by America for, I mean, again, it's just the, how do I want to say this? The woke backlash on just stupid things like this. Like this was worse than, it's like when Jaguar did that absolutely ridiculous commercial, whatever it was, like 3 or 4 years ago. And literally, I mean, it's kind of hard to think that like one commercial could sink your brand, but that's exactly what happened. One horrible commercial, but basically sent Jaguar into a tailspin. And same thing here. The CEO of Cracker Barrel, she comes out with this completely stupid rebrand and almost wrecks the company. And she's taking, I don't know, I saw one chart that she had killed, and there's no chart in this article, but I mean, you know, she killed the company's, I mean, the stock price is like in the toilet, down like 30% from when she first took the helm, because of this stupid rebrand. It's like, you know, I get when a CEO comes in and they like want to, they want to put their stamp on things. I could certainly get that, but there are times when like you don't need to do that. Cracker Barrel was at a very successful brand. They were doing just fine. How about just making sure that the menu is really good and that the food you're serving is really good and that it's being served at a very competitive price. How about, maybe doing something to reward your best customers, do so, instead, again, they didn't need to do this, but again, look at the sign here. They're sitting there and it's all the, oh, you know what? The old white dude here sitting here by the barrel, he's got to get up out of here. He's got to go. Because we need a new modern brand, well, it turns out that didn't fly with people. People like Cracker Barrel the way it was. So like I said here, I think again, another one of the bigger stories this week, but wanted to show that out there. Trump accounts, the signups reached 7 million over this last week. That's pretty astounding. Bessent says, and that's Scott Bessent, Treasury Secretary, says it's the most successful launch in government history. So Treasury Secretary Scott Bessent called Trump accounts the most successful launch in government history, according to prepared remarks Monday, exclusively provided in advance to CNBC. So far, 7 million children have been signed up for the new tax-deferred savings and investment accounts for kids, as per the latest tally. The Trump accounts program is just extremely successful. So far, about 6 million children have signed up. Bessent said that's up from 6.5 million earlier this month. Although many more children are still eligible, the Treasury said early signups have outpaced those for other digital platforms and products as young adults increasingly turn to social media, online communities, and AI for financial advice. Besant said in the remarks, the newly launched investment accounts offer one of the great real-time learning experiences in the history of the United States. Stock wealth has largely been accrued by the richest U.S. households, study showed. According to a Gallup poll cited by Besant, 38% of Americans have no exposure to equities at all. Trump accounts, which officially launched on July 4th, will create a new class of shareholders. Besant said Monday, American families left on the sidelines of Wall Street for too long will finally understand what it feels like to have a piece of the action. Well, I guess technically, if again, you still got to put money into this thing. It's not like you're just going to get this thing. Now, a lot of people will get like that, the $1,000 for signing. Like if you got a newborn baby, or I think if your baby is a year or two old, you could get the $1,000 on this. So a lot of people will get that $1,000, and that's great. It's a nice little start, but you still have to put money into this thing. Like it's not like this. It's not just going to magically create. It's not like a money tree that's going to magically create money for you. Um, but again, I think there are certainly certain advantages to this that make it very appealing to want to jump in. And if you have younger kids, I wish they would have had this. When my kids were first born, I wish I would have had this because I absolutely would have signed them up for this in a minute. But let's see here. So children born from 2025 through 2028 can receive a one-time $1,000 deposit from the Treasury Department as part of a pilot program. Parents, guardians, grandparents, and others can also contribute up to $5,000 per child per year. Those contributions will be invested in exchange-traded funds that track the performance of the S&P 500. With the free money as a draw, Trump accounts could potentially generate $80 billion to more than $900 billion in long-term asset accumulation for children across all income levels over the next decade, according to a recent analysis by consulting firm McKinsey. However, participation, contribution patterns, and sustained engagement are key factors in those outcomes. Yes, absolutely. So, but again, I just wanted to point this out because a phenomenal start. I mean, you got 7 million people signed up on this with more people to come. That's a pretty good start. So, all right, and then finally, around the PayPal. So PayPal is open to a buyout, but is focused on a turnaround. So they did release their second quarter earnings. They had revenue up, rose 5% to $8.68 billion. Now, as I had reported on last week, PayPal got approached by Stripe and a fintech firm, Stripe, and then maybe a private equity firm called Advent. So the two of them were basically partnering up. Advent and Stripe were partnering up, offering to buy PayPal. PayPal basically rebuffed that offer shortly thereafter, saying that price wasn't right, it wasn't good enough for them. So now here we are here. So PayPal bumped up its profitability forecast Tuesday and signaled an openness to a potential deal if it came at the right price. So in its first earnings release since receiving a takeover offer from rival fintech Stripe and buyout firm Advent International, the company said it now expects transaction margin dollars to grow this year to around 15.6 billion from 15.5 billion in 2025. PayPal had previously said the metric, a key measure of profitability, would decline slightly in 2026. Management declined to comment specifically on Stripe's proposal, which values the company at 53 billion. Chief Executive Enrique Lores instead said that the company would evaluate all opportunities to maximize shareholder value. Our board and management team are open and have a clear responsibility to objectively evaluate every opportunity that is presented to us, compare it with our own plan, and choose the option that creates more value. For now, the company is focused on its turnaround strategy. We have a very clear view of the value that we can create in the coming years. So, again, I mean, look, PayPal basically what they're signaling to everyone is that they do want to be bought. They're looking for a sale. They do want to be bought by somebody, but they're not going to give themselves away. They're not going to sell cheap. They're doing what I would call a little bit of window dressing at the moment to try to beef up their price. Stripe and Advent, they may yet still get the job done, but they're going to have to come back they're going to have to sweeten their offer and come back with a better price to get this done. which they very well may do, but we don't know. We'll have to see. I have always been of the thought that there are other better companies out there to buy PayPal. Like I was, kind of sitting there thinking to myself, well, what would happen, for example, if a Robinhood were to buy PayPal, or a Coinbase were to buy PayPal, or a Kraken were to buy PayPal? Again, I think that there are some other companies that could create some very interesting financial powerhouse by buying PayPal and getting their hands on Venmo. So again, could be very interesting, but we will keep an eye on that. So all right, now the U.S. economy slowed to 1.5% rate in the second quarter with GDP, and the June core inflation, which was the PCE, the Federal Reserve's preferred, at least for the moment, their preferred inflation index, remained at 3.3%. So a little bit lower than what was expected, but not, again, still a little high though. So gross domestic product rose at just a 1.5% rate in the first quarter, but underlying economic drivers look solid outside of a drop in inventories and government spending. So the decrease in government spending was the real culprit for the drop in gross domestic product. Which again, that's good. Like we want that, right? We want the government to reduce spending. So that is, I actually view that as a good thing. Inflation readings, as judged by the Federal Reserve's preferred gauge, were mostly in line, but still well above the central bank's 2% target. Consumer spending continued to climb, but the savings rate hit a 4-year low. So economic growth was weaker than expected in the second quarter, though underlying drivers were mostly solid. At the same time, inflation in June held well above the Federal Reserve's goal and complicated the central bank's policy path. Gross domestic product, a broad measure of goods and services, increased just 1.5% for the April through June period, according to the Bureau of Economic Analysis, numbers adjusted for seasonality and inflation. Economists surveyed by the Dow Jones had been looking for a growth rate of around 1.8%, following the 2.1% increase in the first quarter. A separate report showed that the Personal Consumption Expenditures Price Index, the PCE, which is the Federal Reserve's primary forecasting gauge for the moment, fell a seasonally adjusted 0.1% for the month, putting the annual inflation rate at 3.7%. The readings were in line with forecasts. Excluding food and energy, core PCE posted a monthly increase of 0.1% and an annual level of 3.3%. Again, respective forecasts were for 0.2% and 3.3%. So while the Fed technically used the headline PCE numbers as its gauge for setting policy, most officials consider core inflation as a better indicator of long-run trends. Stock market futures were positive following the report, while Treasury yields were sharply higher. So again, so basically here, but GDP better than the headline. So while the GDP number was below expectations, the miss appeared to come from a decline in federal government spending and inventories. Other parts of the economy appeared to be very strong. Key areas of the economy continued to show improvement. Personal spending rose 2.1% after eking out a 0.4% gain in the first quarter, while a key indicator of underlying demand called final sales to private domestic purchases posted a robust 3.9% increase. However, inventories fell 0.7% and federal spending was off just 0.3%, subtracting from the top line reading. Gross domestic investment rose 0.5%, while exports also increased 0.5% and imports declined 1.5%. Exports generally add to GDP while imports subtract. Inflation about as expected, but still too high, still above that 2% goal by the Federal Reserve, but not worsening, not getting worse for us here in the month of July. So, all right. So those were our Fed and inflation numbers here. Now let's jump into our conversation on the Federal Reserve. So this was the FOMC statement. Now, what do you notice about this? What pops out at you? It's incredibly short. It's incredibly short. And let's read this because we read it real quick. The Federal Open Markets Committee approved the following statement for release by a 9-3 vote. Three dissenting votes on the panel for this last meeting. So the committee decided to maintain the target range at the federal funds rate of 3.5 to 3.75% in support of the Federal Reserve's dual mandate. The committee is continuing its policy of maintaining ample reserves in the banking system. Economic activity is expanding at a solid pace despite elevated uncertainty that owes in part to the conflict in the Middle East. Productivity growth and capital investment are strong. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The committee will deliver price stability. So, again, very short statement here by the Federal Reserve as compared to what we're normally used to getting from them. Here's an article. Here's what's changed in the Warsh statement. So again, we went from a unanimous 12-0 vote the last committee meeting to a 9-3 vote. The committee, instead of reaffirms, is continuing its policy of maintaining ample reserves. And then again here, taking out at the bottom, voting against the monetary policy action were Beth M. Hammock, Neil Kashkari, and Lori Logan, who preferred to raise the target range for the federal funds rate by a 0.25 percentage point at this meeting. So that was what we said. So again, not much changing here in the statement. Then we go to here. Here are the 5 big takeaways from this week's Federal Reserve meeting. So number 1, the family fight returns. So 3 voters on the Federal Open Markets Committee voted against the hold, favoring instead a 0.25 percentage point hike. I asked for a good family fight, and I got one. That's the purpose. That's the design feature, Warsh said. There was a lot more interaction between and among my colleagues. It was a real family fight. All the no votes came from regional presidents, Lori Logan of Dallas, Neil Kashkari of Minneapolis, and Beth Hammock of Cleveland. None terribly surprising given previous statements they made. Number 2, another short and sweet statement. Other than detailing the no votes, the statement was unchanged and still dramatically shorter than the Fed norm. Number 3, dedicated to slaying inflation, but Warsh again stated the Fed's resolve to keep inflation under control, but braced markets and the public that it won't be an easy fight, nor will it end soon. We've got no magic wand, he said. This isn't something that we're going to be able to carry out in the days or weeks ahead. The Fed, here's the problem, and I've talked about this many times. The Fed has options. They have tools in their toolkit. However, everything has its trade-offs. Everything has its pros and cons. And while they may fix a problem when they do something at this point, they're really in a darned if they do, darned if they don't situation, no matter what they do. And they could do something over here that might fix this problem over here, but in doing so, you're either going to exacerbate an existing problem on the other side, or you're going to break something which is going to create a whole nother problem. Like, in other words, you jack up interest rates, right? Like, okay, that might bring inflation down. That might also break the economy. It might break the AI trade. It might, break a lot of things that could could trigger a recession. So there's a lot of things to think about there. So when he basically says that, like, yeah, this is going to be, brace some. This is not going to be an easy fight, nor will it end soon. Like, yeah, he's not kidding about that. Number 4, revolt in the market. So despite the chairman's tough talk on inflation, markets weren't having it. Treasury yields at the long end of the curve soared, even as the policy-sensitive 2-year dipped. Translation, we think you're going to keep short-term policy rates in check, and it's going to create a ton of inflation later. The 30-year bond was the biggest gainer, roaring higher at 11.5 basis points to 5.211%, its highest yield since 2007. And seemingly undercutting Warsh's inflation warrior credentials. Yes, see, so again, all the stuff I pointed out at the very beginning of the show tonight when I was talking about the 30-year bond. What did it say there? I said it was the highest yield since 2007. There you go. Boom. Check the box right there. It went higher there. Now, also, I want you, what did I also talk about at the beginning of the show tonight? I talked about the narrative. I talked about what was the narrative here? The narrative here. We think you're going to create, we think. Who is we? That being the media is saying that this is coming from the bond market. So the media is saying that the we is the bond market. So the bond market thinks you're going to keep short-term policy rates in check, and it's going to create a ton of inflation later. So we're going to see this massive spike in inflation because they're holding policy in check. So in other words, putting the pressure on, putting a ton of pressure on Warsh to basically increase interest rates. So and that basically, if he doesn't increase interest rates and we get more inflation down the road, it's all going to be, oh, we told you so, we told you so, we told you so. And then number 5, no clues on September. So investors looking to get any further hints on whether the Fed will hike at the September 15th, 16th FOMC meeting were largely out of luck. The statement offered no clues either on forward guidance or even on the reaction function, and Warsh was at best cryptic on which way he will push. So I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is going to help us make better decisions, and in so doing, satisfy our remit, Warsh said. And now again, Warsh is trying to take the forward guidance out of the equation. He's trying to take that out of the equation, and he's trying to leave it to the bond market to basically make the decision and say, okay, guys, you got to figure out what we're doing here, and then you need to decide how you're trading. We're not going to, the Federal Reserve is not going to tell you how to trade. We're not going to give you that guidance anymore. So again, that kind of adds a little turmoil to the market, right? Because it adds uncertainty. Market doesn't like uncertainty. And it's like, oh, what? But then it's also like, oh my gosh, what do we do? They're not telling us what to do. What should we do? And then they've got to kind of figure it out for themselves, which is the way that prior to 07, 08, that's the way the market always operated. The market had to figure out itself. The market had to try to determine, okay, are they going to raise rates, not raise rates, and what does that mean? So again, interesting. So again, the 5 big takeaways: the family fight returns. You bet it did. 2, another short and sweet statement. Yeah, very short FOMC statement. Dedication to slaying inflation, but not really a whole lot happening at the moment. Number 4, the revolt in the marketplace, particularly the bond market. And then number 5, no clues on September, forward guidance being pulled out again. So that was our big takeaways. So then we get into divided Fed holds interest rates steady, but 3 members voted to hike. So again, the Federal Reserve held interest rates steady. The 3 regional presidents, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, dissented as inflation has remained above the Fed's 2% target for more than 5 years. Again, I love how when Jerome Powell was there for 8 years, not that these guys said nothing, but they said very little. And they said very little and didn't dissent against Jerome Powell, whatever. The minute that Kevin Warsh gets in there, now all of a sudden they're concerned. Now they've got, oh, we're so concerned about inflation, whatever. Really? Because, and they're like, oh, well, we haven't hit our target for more than 5 years. Well, whose fault is that? You're the guys that have been there running things for the last 5 years. So whose fault is that? But it's just comical how now all of a sudden they found religion. Now all of a sudden it's like, we need to be on top of this, and we need to manage the inflation. We need to get it back down. It's like, yeah, it's kind of funny. You didn't seem overtly concerned with this in years past, but now all of a sudden you're concerned, right? So again, just very interesting. Kevin Warsh, has argued for giving the markets fewer signals about the central bank's next move. So then we go into this. Fed officials who voted to hike rates say action is needed now against inflation. So regional, again, these the three presidents here. They explain why they favor higher interest rates in separate statements on Friday. Hammock said Fed policy currently isn't restrictive enough, while Kashgari said the Fed needs to address persistent supply shocks that have pushed prices higher. So, Federal Reserve officials who voted this week against the decision to hold interest rates steady said Friday they favor hiking now as a way to stave off inflation. In my view, now is the time for the FOMC to act to speed the return of PCE inflation to our 2% objective and deliver on our commitment to price stability for the American people. Cleveland Fed President Beth Hammock said in a statement, the longer that high inflation persists, the more challenging and costly it can be to bring it back down. So I have said this before. I have talked a lot about inflation and the spending or whatever. I think, you have two big things going on here. Number one is you have the situation over in Iran. And the situation over in Iran is creating what's called a supply side shock to the inflation. The supply side shock. So in other words, if you took out, think about it like this. Let's take out that. Let's say Iran. Let's say this whole thing ended tomorrow. We had peace. Strait of Hormuz is open back up. Everything is settles down. Everything's okay again. Iran starts generating oil production. Everything kind of just goes back to normal, if you will, in terms of energy production and energy movement throughout that region. So you would probably, PCE inflation, again, coming in at 3.3% for the core, the overall coming at 3.7%. That's probably coming back down. There's probably either a full point to maybe even, 1.2, 1.3% into that baked into that number. So inflation could come back, could immediately, if that was over, inflation would come back down to say like 2.5, 2.6, something like that. So that's the supply side shock that's kind of built into that equation. So if you take that out, that would bring inflation back down a lot. So again, part of this is a supply side shock, and what history has taught us about a supply side shock is that raising interest rates is not going to do anything to fix that issue, because it's a supply and demand issue. It's not something that they can readily push back on. The other side of that equation is government spending. Again, you have fiscal policy, you have monetary policy. The Federal Reserve handling the monetary end of that equation, the US government handling the fiscal end of that equation. Now, the fiscal policy, has been to basically just spend money and spend money and spend money and spend more money. You're never going to get inflation back down under 2% unless the government cuts the money. You've got to reduce the spending. If you reduce the spending, that inflation number comes down. That inflation number, remember, inflation doesn't come out of nowhere. Inflation comes from government spending, the government pumping too much money into the economy. When we are running $1.6 trillion national deficits every single year, okay, that is the government spending too much money in the money supply, and that is going to create the inflation that we're talking about. What did the Federal Reserve do over the last couple of years? Jerome Powell, what did he do? He brought the Fed's balance sheet back down. And what happened? Miraculously, oh, wait, the inflation started to come down. You're kidding me, right? It's amazing how that happens. The Fed brings the balance sheet down, inflation starts to come back down. They also increased interest rates, which basically, slowed things down. That helped. I'm not saying it doesn't help, but I'm just saying that it's really more about the spending. If you could get the government spending down, you will really help with the inflation issue here on this. But like I said, it's again, it's these two main things. It's the government spending and it's the Iran situation. creating a supply side shock. It's not so much that you've got companies jacking. I mean, they are jacking prices up. Um, but that's a byproduct of the overall thing. They're jacking up prices because they feel that they need to, because they're like, oh my gosh, our expenses are going up. We got to maintain our profit levels. We got to increase money. Some companies are just gouging their consumers, no doubt. To be sure, that's happening. But I think the vast majority of companies out there are basically just doing it and in reaction to what is happening to them in the moment in the market. So again, just to set the stage on that, but this idea that, like, oh well, we need to jack up interest rates right now. We need to jack interest rates up right now. And I'll just put this out there. Um, could it be a political thing? Like, could it be I'm just asking people to consider this. Could it be that Jerome Powell and President Trump don't like each other? They absolutely don't. They actually despise each other. They don't get along well. Jerome Powell is more on the Democrat side of the equation. And, could it be that they want to jack rates to kind of stick it to him, to ruin the economy, and basically just, make his life as hard as possible? Could that be part of the motivation here? Maybe. Maybe that could be. I'm not saying it totally is. I'm just saying that you can't rule that out. Like, I think that's a big part of what is going on here. So, so again, so we got that now, but let's continue on here. So what did President Trump think about all this? Well, Trump backs fantastic wash while calling for lower rates and citing bad intentions of other Fed officials. There you go. What was I just saying? President Donald Trump called Federal Reserve Chairman Kevin Warsh fantastic, but wasn't as complimentary to the central bank leader's fellow officials. Some Fed policymakers are very political and perhaps have bad intentions, the president told reporters above Air Force One. The comments come 2 days before the Fed's next interest rate decision. Trump said the U.S. should have the lowest interest rates in the world. Well, I don't know about all that. Um, again, the problem here is that, could our rates be lower? Yes, our rates could be lower. They could absolutely be lower. Um, has that opportunity gone out the window? Yes, I think that opportunity has gone. I think we missed the boat. I think Jerome Powell, he had the opportunity to lower interest rates over the last couple of years. He did lower them a little bit, 75 basis points. I don't think that was anywhere near enough. I think he should have done another 75 basis points to maybe even a point, to take us down. And I think that would have been enough. I think that would have been appropriate. But again, he waited too long. He didn't want to cooperate with President Trump. He wanted to do what he wanted to do. And he did decrease interest rates a little bit, but I think more so that was just to basically say, well, hey, if anybody asks, it's like, well, I did decrease rates. I did decrease rates, so that way, people can't hammer him or beat up on him too much. Um, but he wasn't doing that. He wasn't doing it out of the generosity of his heart, and he wasn't doing it because he thought it was the right thing to do. He was doing it more for political cover, just to make it look like he was doing something. Um, but anyway, so Trump, so basically the gist of this is that basically, Trump still okay with Warsh, basically would still prefer to have rates lower. Even though, like I said, I think that unfortunately is off the table for the moment. But he calls out the intentions of some of these other, Fed officials, which again, I can't say that is completely untrue. I think you have to at least take that into consideration. So, all right, now a couple other things on this before we move into what do I got here? Three articles here, kind of on the or I say four articles here on the bond market, and then I want to get into some private credit news. So let's just run through this for a minute here. So Kevin Warsh's honeymoon with the bond market is already over, 30 days in. Investors warn that the Fed must show commitment to inflation fight after Wednesday's sell-off. Now, this gets in to what I was talking about earlier with the whole, and you're seeing this narrative formed almost immediately afterwards that, like, oh, the bond market acted completely The bond market acted completely to the Federal Reserve not increasing interest rates, whereas I don't believe that. I'm not saying that they didn't act to that, but what I'm saying is that there was a lot of other things in the mix there, which led ultimately to interest rates going up. Like I said, the escalation of the incident with Iran. The national debt, continuing to become more and more of a pressing issue. Some of the financial numbers with GDP and inflation, all those things, factoring into what the how the bond market is basically viewing and thinking about some of this stuff here. So, but the bond market has a message for Kevin Warsh. Don't try that again. Yields on longer term U.S. Treasuries held near their highest level in 19 years Thursday, a day after Federal Reserve Chairman jolted the market by failing to persuade investors that he was willing to support rate increases to fight inflation. The moves were unusual and alarming. Even as yields on longer term bonds surged, those on short term treasuries fell, indicating concerns that the Fed would wait too long to lift rates and then have to raise them aggressively down the road. Now, could it be, if we go back to what we talked about at the beginning here, when we talked about the failure of the situational awareness hedge fund, and we talk about some of the potential games that Citadel was playing and about how they put out this false report of the Fed increasing rates at the meeting. Is it possible? I'm just asking the question. Is it possible that some of that was at play here for, again, why these moves were, again, according to here, unusual and alarming? Could it be that there was maybe some other things going on here than simply the Fed coming out? Again, nobody was shocked by the Fed. I wasn't shocked by the Fed coming out and basically saying, yeah, we're just going to stand pat. We're not going to do anything. That was what I was expecting. I think that's what most people were expecting. So therefore, there had to be more to the interest rates going up. There had to be more to the way that the bond market responded here. There's got to be something else going on here. But again, they chose, again, meaning the business news media chose to focus in solely on this and basically try to lay the blame immediately at the feet of Kevin Warsh, basically saying, hey, this is your problem, dude. You did all this stuff, whatever. And then we're going to take a look at this here for a second. So I just want to show this chart. Shape shifter, the U.S. Treasury yield curve. So in the brown here, you can see this spike up on the yield curve. Basically, the 20-year here up to 5.22%. 30 years ago, let's see here, or 1 year ago, the 30-year was at 4.89. 2 years ago, the 20-year was at, and then the 20-year was at the 4.5. 30-year was at the 4.44%. But again, I think the important thing to take away from this chart is just look at the steepness of what happened here. I mean, look at this steepness here in the brown figure here. This was for Thursday. This is the black was for 1 year ago. The blue was for 2 years ago. But just look at the steepness in the climb over the last month here, just shooting up. Again, that is definitely not what we want to see at the moment in the yield curve. We don't want to see this, straight up, almost hockey stick type movement. We want to see a more slow, we want to see a sloping curve, and we want to see it upward sloping. That's for sure, but we don't want the steepness. We don't want it to be that steep. So, all right, so we show you that. Then we go in here. Bond market is testing Warsh's non-committal rate outlook. So again here, bond markets are skeptical of Federal Reserve Chairman Kevin Warsh's commitment to fighting inflation. Rising long-term treasury yields signal bond traders' concerns about inflation and doubts about the Fed's resolve. Federal Reserve Chairman Kevin Warsh says he's committed to bringing inflation down, but the bond market isn't buying it unless he shows a willingness to raise interest rates. Analysts say it's a tension that's driving up mortgage rates and other long-term borrowing costs today as traders question whether Warsh can fight inflation with only words and not actions. So at his second press conference as the Fed chairman, Warsh said the central bank remains resolute and will not waver as it looks to bring inflation back to its 2.5% target. The Fed, however, did not raise short-term interest rates, nor did it give markets a clear sense that rate hikes were coming soon. So yeah, well, because he didn't, he wanted to get rid of the forward guidance. So he said instead, the press conference was all hat and no cattle. A Bank of America analyst wrote in a note to clients. Bond markets are now questioning the Fed's inflation fighting resolve, he wrote, which could force Warsh into hiking rates at the Fed's next meeting. Now, again, Warsh could do absolutely nothing. And if in the next week they announce a peace plan with Iran, and like I said, everything over there in the market starts to go back to normal, boom, inflation starts to come back down, and Kevin Warsh doesn't have to do anything. He just sits here and stands pat. That could happen, and the funny thing here is just it's the narrative around here. Basically, you see this narrative forming that the further increase in inflation is a bygone conclusion. This is going to happen, and we're gonna lay this at Kevin Warsh's feet when it does, and we're gonna roast him for basically being a horrible, Federal Reserve chairman, which again is almost laughable in a sense because the guy's been there for 30 days. But again, I'm pointing this out on purpose because I want you to see the narrative. Okay. And then last article here on the Fed stuff. So analysis, Fed Chairman Warsh's credibility in question after leaving rates unchanged. Again, here, like I said, credibility. So Kevin Warsh chaired his second meeting of the Federal Reserve's rate setting committee, where officials voted 9-3 to leave interest rates unchanged. Investors lowered the odds of a near-term rate hike, but pushed long-term Treasury yields higher after the Fed chairman's news conference. Warsh declined to spell out what would make him raise rates consistent with his move away from forward guidance. The market reactions raised early questions about Warsh's credibility on inflation and his ability to lead a divided Fed. So again, you got to watch the narrative here. We're seeing this narrative play out. But we'll see. Like I said, we'll see. If Kevin Warsh, we got to give him a little bit of time here. We got to give him a little time to see if his plan can play out. As I reported a couple weeks ago, Kevin Warsh has formed these 5 committees. He's given them time. He's going to wait for them to get back to him here toward the end of the year. And then based on their recommendations, he will then chart a path forward going into 2027. And so, we got to give him a little bit of time. We got to give him a little bit of time here. We can't, but again, you see what's happening with what Jerome Powell is doing here. Like you see that there's a coordinated effort here between what Jerome Powell and his cronies are doing in the Fed and the coordination between the media, the business news media. It's like you get 3 of Jerome Powell's buddies come out as dissenting voters, pushing back, saying we need to increase interest rates, causing the pressure on Warsh. And then you see all the narrative out in the press. They're like, oh, look at what he's doing to the bond market. This is all his fault because he's not increasing interest rates. And, oh, look at the 3 Fed governors that dissented against him. We've got all this dissent. And, so, and again, what's funny about the dissent is that the dissent prior to Kevin Warsh coming a month ago, dissent was a horrible thing. That was a bad thing. How could you ever dissent against Jerome Powell or Ben Bernanke or Janet Yellen? You will not dissent against the 3 amigos. Like that was taboo. It was a horrible thing. You are a horrible person and you shouldn't even be there if you dissented. But now if you dissent against Kevin Warsh, you're a hero. You're a hero if you dissent against Kevin Warsh, and you should be dissenting against Kevin Warsh. So it's just again, you gotta again. I don't like delving into all the politics necessarily of all this narrative, but it's critical. Like it's critical to understand the narrative, to be able to see through the narrative at different times, and being able to really get at the heart of what is really happening and what is really going on. But Like I said, you're going to be able to tell the narrative. Like I said, this is just the beginning. This is just the very beginning here. Like I said, if Kevin Warsh, if he plays ball and he does what Jerome Powell and his cronies over there, if he does what they want him to do, he will get showered with positive press. Everything will be good. He'll get invited to all the cocktail parties, and all that will be great. Okay. If he does perhaps the right thing, and he does what he follows his convictions, and he does what he knows to be right, what he knows to be good for the market in the long term as opposed to the short term. If he does that, even though as bad as it might be, I think he'll turn out a lot better for it at the end of the day. But if he does go down that road, if he goes down the road of reform and change, and I'm going to do things differently, again, Jerome Powell and his cronies, along with their accomplices in the business news media, they're going to be right there to try to basically cook Kevin Warsh, to just absolutely cook him. So, all right, so that's our Fed conversation. I've got a bunch of very interesting news, updated news here on private credit. But before we get into that, I want to switch gears here. I want to jump back to this is the part in the program where I always like to give everybody the economic indicators coming up for this week. I love to give everybody some bank news, and then I like to talk about what episodes that I had that came out this last week. So first, let's get in here to the economic indicators. You can see I have up there on the screen. So on Monday, August 3rd, we get the manufacturing PMI for July, we get the construction spending for June, and we get the ISM manufacturing PMI for July. On Tuesday, August 4th, we get the trade balance for June, the factory orders for June, the JOLTS job openings for June, and we get the API weekly crude oil stock. On Wednesday, August 5th, we get the ADP non-farm employment change for July, services PMI for July, the ISM non-manufacturing PMI for July. Thursday, August 6th, we get initial jobless claims and then continuing jobless claims. And then finally, on Friday, August 7th, we get the average hourly earnings for July, the non-farm payrolls for July, participation rate for July, private non-farm payrolls for July, the unemployment rate for July, consumer inflation expectations for July, and finally, the consumer credit for June. So those are your economic indicators coming up this week. A lot of really good information coming out, and we're going to keep an eye on all of this stuff. So, all right, now let's get to some bank news for a few minutes, shall we? So mortgage rates continue to rise. We talked about that at the very beginning. Personal income and spending rise in June. Enterprise mortgage foreclosures drop in April. So the Federal Housing Finance Agency reported that the 60-day delinquency rate for Fannie Mae and Freddie Mac increased to 0.94% in April, while the serious delinquency rate dropped to 0.58%. Foreclosure starts declined 2.7% during the month, while third-party and foreclosure sales increased by 3.2%. Home prices increased in May, and consumer confidence dipped in July. New home sales increased in June. FinCEN issues alert on student aid fraud schemes. So the Financial Crimes Enforcement Network issued an alert urging financial institutions to detect, prevent, and report suspicious activity connected to fraud schemes targeting student aid programs administered by the federal government. The House panel seeks feedback on the Consumer Financial Protection Bureau reform proposal. So we'll see what comes with that. Durable goods orders increased in June. The GAO, the Government Accountability Office, agencies should identify, address burdensome regulations. So the GAO said federal banking agencies should identify outdated, unnecessary, or unduly burdensome regulations and take actions to address them. Mortgage applications decrease in July. Treasury redesigns the CFIUS website. That is the Committee on Foreign Investment in the United States. FinCEN renewing OMB control number for customer satisfaction survey plan. So the Financial Crimes Enforcement Network published a 60-day notice to renew the Office of Management and Budget Control number assigned to certain Bank Secrecy Act regulations related to the generic clearance plan for the collection of qualitative feedback on agency service delivery. Fannie Mae reported $4 billion net income for the second quarter of 2026. Same day, ACH payments jump in the second quarter for the ACH network. Saw an almost 30% gain in same day ACH during the second quarter. Yes, so I'll have more on that this week. ICBA, state groups to agencies, ensure citizenship executive order doesn't burden community banks. ICBA and 34 state banking associations urge the Treasury and the Financial Crimes Enforcement Network to ensure that implementation of recent executive order and advisory does not burden community banks. Now, this is one that I am totally on board with. I think the banks should be determining whether or not they are banking U.S. citizens or not. And if they are not banking U.S. citizens, they should stop. So I am actually all for this. I don't, it does not bother me that if banks get a little extra burden for having to prove people's citizenship, then so be it. Agencies publish revised CBLR compliance guide. So the federal banking regulators published revisions to the compliance guide for the community bank leverage ratio framework. So the CBLR simplifies regulatory capital requirements for community banks that choose to adopt it, replacing risk-based capital ratios with a relatively simple leverage ratio available for eligible banks with assets below 10 billion. Approximately 40% of qualifying banks have opted into the CBLR framework. So ICBA says Fannie and Freddie should not expand into chattel lending. So ICBA said Fannie Mae and Freddie Mac should not expand into manufactured housing chattel lending while they remain undercapitalized and in federal conservatorship. So yes, they should be out of federal conservatorship. I think it's ridiculous that they're still in there. Almost, now we're pressing up on what's going to be like 20 years since the financial crisis. They've been in conservatorship. That again, that I've talked about that in past episodes. You could definitely search that on the channel and see about that. Treasury Office issues shadow AI warning. So the Treasury Department's Office of Cybersecurity and Critical Infrastructure Protection published information on securing against artificial intelligence related threats. So AI tools are accelerating adversity's ability to discover and exploit vulnerabilities, like tools like Anthropic and OpenAI. Sorry, no, I just included that last one in there. But we all know that's not far off. I mean, that's where these AI tools are coming from. Come on. Yeah, it's a big issue. And I'm going to show you here in a few minutes. Hey, stay with me, because in a few minutes, I'm going to get into our AI running wild little segment. You'll love that. ICBA expresses strong concern with Fed's payment account proposal. So ICBA expressed strong concerns with the Federal Reserve's proposed payment account, commonly known as the skinny master account, and urged the agency to ensure any such program is subject to strict guardrails and mandatory review. A new article highlights community bank perspective on the skinny account proposal. So a new article highlights community bank letters to the Federal Reserve raising concerns with its proposed payment account, commonly known again as the skinny master account. In new Bloomberg TV interview, Romero Rainey urges lawmakers to fix the Clarity Act. So in an interview on Bloomberg Television, ICBA President and CEO Rebecca Romero Rainey called on Congress to get the Clarity Act right and protect community banks' ability to lend. ICBA urges BSA AML standards for stablecoin issuers comparable to community bank regime. So ICBA called on regulators to establish anti-money laundering and sanctions compliance standards for permitted payment stablecoin issuers, or PPSIs, that are no less stringent than the framework that applies to community banks. So, okay, we'll keep an eye on that. And then ICBA, Clarity Act will reduce community lending, with senators working on bringing the Clarity Act digital asset market structure legislation to a vote soon. ICBA weighed in on recent support for the bill from the head of a Wall Street firm. So And let me see here. Was that from David Solomon from Goldman Sachs. So, all right, again, the fight over the Clarity Act continues. We'll see what happens with that. If I get any breaking news on that, I'll be sure to come back and share that with everyone. All right, let me take a quick peek here at the episodes that I put out this week. So, all right, so going back to last Sunday, I had a BND strategy room bonus episode, which was taken from last week's live stream, and that was called Increasing Yields on the 30-Year Treasury. And that's where I go into about a 10-minute conversation about, what is the 30-year Treasury? Why should you care about it? What does it mean ultimately to everyone at the end of the day? So if you want to learn a little bit about the 30-year Treasury, go check out that short bonus episode there. Then on Monday, I started with the new episodes. So on Monday, I did a review of the ICBA Advocacy in Action for the third quarter of 2026. I always love covering that report because it's basically just a 2-page PDF going over all what I would call the top regulatory hot button issues in the banking industry. So again, if you want, and I love that because it usually gives me about a 15 minutes. I could do a very quick rundown. I get you all up to date on what's the current regulatory topics going on in the banking industry. What are some of the wins? What are some of the things that are still big concerns? So again, if you just want that quick regulatory update, that episode is great for that. You can go and check that out. Then on Tuesday, I did community bank earnings for the second quarter of 2026, net interest margin compression, loan growth, and expensive deposits. So I talked about how the earnings for community banks in the second quarter of 2026. It basically talked about there was a little bit of net margin compression, loan growth continued to increase, particularly around C&I lending. Some of the underwriting did tighten up a little bit. But there's this big question around deposits. Deposit base remains sticky, but the funding costs remain higher. We're moving to a little bit more of a mix and a more even a somewhat concentration in CDs, which is a little strange because banks haven't been there in that situation for quite a while. So again, if you want more on that second quarter for bank earnings, go check that out. On Wednesday, I did another bank news episode, which was called M&A News and Approval Timelines, Charter Updates, and Bankers Go to Jail. So again, and those episodes I think are fun. I really enjoy. People are really liking those episodes. I'm enjoying doing them, and it's just kind of a simple way. I just try to get 10 or 12 articles that focus on the main topics or main things going on in the world of banking. Not necessarily things that I hit on in the live stream, because a lot of it's just, there was this little merger and acquisition. Maybe some fintech company was doing this or whatever. So a lot of things that I don't necessarily get a chance to touch on in the live stream, I try to cover in those little bank news episodes that are, again, usually about 15 minutes. But try to get people just the kind of basic gist of, hey, here's a lot of the banking news that was going on for that particular week. So, all right, then on Wednesday I did examining the 7 types of check fraud. I thought this was a really important episode. So for all the people that don't know, there are 7 different types of check fraud. They include new account fraud, check kiting, dormant account fraud, counter check fraud, withdrawal fraud, and deposit ticket fraud, and split deposit fraud. So which type is the most common? Which is the most invisible? Which is the most evolving? Which is the most targeted? And what can banks do to combat all these different types of check fraud? So banks have many tools at their disposal, including like Positive Pay, SARS, customer education, Federal Reserve tools, and employee training. But again, if you want to check that out, learn a little bit more about check fraud, check that episode out. Then on Friday, I did the race is on to secure bank charters. So bank regulators have been approving a lot of bank charters recently, and multiple types of charters at that. De novo charter, trust charter, national bank charter, and ILC charter, just to name a few. While the OCC is approving charters, that does not mean their standards for retaining approval have diminished. There has been a surge of crypto, fintech, and digital asset companies applying for various types of bank charters and Federal Reserve master accounts. However, time might be running out. President Trump's second term ends in January of 2029, and midterm elections are coming up in November. If Republicans lose control of the House of Representatives to the Democrats, things could change very quickly. There has probably never been a more favorable time to seek a bank charter, but how much longer will that last? So that was the big question. So those were the 5 episodes that I put out this week. Again, I try, for anybody who doesn't know, I try to put out new episodes every week, Monday through Friday, basically at noon every day. And those episodes are usually very occasionally I get an episode that's over 20 minutes. That's not the norm. Normal episodes, I would say, are between 10 to 15 minutes. Try to keep them short and sweet to get you in and out and get you what you need and keep you moving. That's basically the premise of what I try to do on just a lot of the regular channel videos. And then but again, the live stream works into all of this. Like the episodes work with the live stream works with all the episodes. Like I really try to use a lot of I talk about pretty much everything that gets talked about in the episodes gets kind of touched on in the live stream at one time or another. But I also use the episodes to do a deeper dive on a lot of the topics that I just have only time to bring up and hit on for maybe a minute or two in the live stream. So again, it's an ecosystem, right? Like it all works together. All these episodes that I put together, along with the live stream, they all flow together. If you're paying attention to a lot of this stuff, you're going to know everything that's going on in the banking business, the banking industry, the world of finance, the economics. You're going to have all that information at your fingertips. You're going to know what's going on. And hopefully you're going to learn a lot as we go through all this on this podcast. And that's the whole point of this, is to be very educational. I don't sell anything. I'm not here to sell anything. I don't have any get rich quick schemes. As a matter of fact, my idea of getting rich is called getting rich slowly. It is a very time tested formula. But it requires a long time for it to happen. Okay, I do not believe in get rich quick schemes. I don't believe that works, or that those things are successful. I think a lot of times it's more luck or being in the right place at the right time. So that's kind of my philosophy. My philosophy is more get rich slowly. In some cases, very slowly, but it's about building things over time, as opposed to hitting the lottery. Anyway, all right. So that's that. One thing I did want to point out. So here, I just want to show everybody this for the moment. So here's the YouTube channel page right here for the Banker Next Door. And I wanted to show this to everybody. As a matter of fact, I'm gonna blow this up a little bit here, because I just wanted to show this to everybody. So I have everything. If you've never been on here, I have everything categorized here on the YouTube page, and I added a couple new categories. So anybody, if you just like the bank news episodes and you just want to watch those, I created a playlist just for the bank news episodes. So there's 11 videos in there right now that basically cover the last 3 months. So if you want to go in there and just watch those videos, you could just watch all those. I created, because of the fact that last week we hit 4 bank failures for 2026. It really got me thinking, like, you know what? I've covered a lot of bank failures over the last 4 years, and there's a lot of really good, interesting stories in there. So I decided, I went back, I got all of the episodes that I've done covering bank failures over, so basically starting in 2023. So 23, 24, 25, 26. So I had 16 episodes, and I basically created a new playlist called Bank Failures and put all those episodes into that playlist. So created bank failures, created bank news. I also created a best of BND. When I was on vacation a few weeks back, I started this. I did like 2 weeks of the best of BND. The first week I did on the Lords of Easy Money. The second week I did interviews, so the best of BND interviews. So I decided to create a playlist for that and put those in there. And again, I will build on that playlist in the years to come. As you know, again, as I hopefully I go, hopefully I get to more vacations and things like that. But some of the other playlists that you may not be aware of. So I have one called Regulation Reports and Analysis that have a lot of stuff in it. Bank Technology and AI. BND Strategy Room has its own full playlist. The Lords of Easy Money has its own playlist. I have one for interviews, one for just a banking related, which is kind of like a catch-all for anything just in general that I do in the banking or finance world. I have one for book reviews. I'll be adding a couple to that very shortly. Working on a couple. I don't know if I'll have those for this week. I'm hoping to have, if not this week, definitely next week. I'm trying to put the finishing touches on those episodes right now. I have business movie and documentary reviews. Now, um, anything that I cover movie wise or documentary wise, and I've covered a few, it has to be business related because it has to relate to the channel. It has to relate to some of the topics of things that we're talking about here, and that's why I work those in and put those into it. And then finally, I had the crypto series. So everything and anything in the world of crypto, I cover in that. I have not done a crypto series installment for a little while here. I'm going to get back to that real shortly. I'm actually working on putting together a crypto week. I'll have 5 straight crypto episodes because I got a stack of crypto stuff that I need to get into and report on for things that have been going on here for the last couple of months. But like I said, just wanted to show that to everybody just to see how the channel, how I kind of categorized everything on the channel and have developed these different playlists over time and put things together. I need to work on, I've seen other channels on YouTube that have done these compilations where they'll have 3 hours or 4 hours of these compilation videos on a particular topic. I'd like to do some of those. I've also seen these like 24-hour watch-alongs. I'd like to do that maybe with Strategy Room. Maybe I'll put together 24 hours where maybe I'll put together like 10 or 12 live stream episodes and just run that for 24 hours. So I gotta figure out how to do a couple of those things and see if I could do throw a couple of those things in the works. But anyway, all right, let's get back. We still got a lot of stuff to cover here. I need another 30 or 40 minutes here with everybody to get through the rest of this stuff here. So what are we going to cover in the rest of the episode, the rest of the live stream here today? So I got this update here on private credit. We're going to talk about earnings for a bunch of the tech and AI companies. We're going to talk about what's going on, some of the crazy things that are happening in AI right now, basically the AI trade. Then I've got some things on the back end. We're going to talk about Robinhood for a couple of minutes. We're going to talk about a couple Epstein related articles here. We're going to talk a little bit about nuclear reactors. I've got some very interesting updates of some things that are kind of wild on nuclear reactors. Then we're going to wrap it up. I've got 4 articles on the automotive industry and some of the things that are happening there. And so we'll wrap up with a little kind of automotive conversation here. But let's dive into this for a minute here. So BlackRock, so private credit, 2 big resignations here in the last 30 days here. So the first one here, BlackRock CEO exits, signals private credit shift. Now, this is not Larry Fink. This is a CEO of a lower division for BlackRock. So this isn't Larry. Don't get too excited that Larry Fink is going anywhere. But then we also have this one here, Jonathan Bach, and I'm going to see if I can make this a little bit bigger here for everybody to see. Jonathan Bach resigns as co-CEO of Blackstone's CBRED and BXSL. So things were a little quiet here. They've been a little quiet in the private credit market. Things have kind of calmed down. We haven't had any major delinquencies here in the last couple of weeks. The withdrawal requests on some of the funds are still high, but have kind of reversed a little bit. But again, having these two, the fact that you had these two major resignations and the fact that there was basically been zero coverage of this tells you a lot. They're trying to do this very quietly without creating a big stir on this. But let's look at this for a second. So BlackRock CEO exit signals private credit shift. So a steep, and that NAV is net asset value for anybody who doesn't know, but net asset value drop on a federal probe triggered a high level departure at BlackRock. The private credit market's roughest stretch in years has claimed its first senior leader at a major asset manager. BlackRock's Phil Seng is in the process of leaving his post as CEO of the firm's publicly traded business development company, according to Bloomberg News. The move comes amid a brutal year for BlackRock TCP Capital Corp. The firm marked down its net asset value twice in 2026 by 19% in January and another 5% in May. Meanwhile, federal prosecutors in Manhattan have been reportedly probing the fund and questioning executives as part of the inquiry. Seng and acquire hire from BlackRock's 2018 acquisition of Tenenbaum Capital Partners remains employed for now with no set departure timeline. Seng's exit echoes a pattern that emerged last fall when two auto-related borrowers collapsed and rattled private lenders. Cleveland-based First Brands filed for Chapter 11 in September. Then you also had Tricolor Holdings. In the same month, subprime auto lender Tricolor Holdings began liquidating. Federal prosecutors later indicated founder and CEO Daniel Chu and Chief Operating Officer David Goodgame alleging the pair systematically misled lenders to keep credit lines open. Goodname pleaded guilty in June to 6 counts, including bank fraud and conspiracy, and is now cooperating with prosecutors, a deal that could put him on the stand against Chu, who has pleaded not guilty. Industry executives have largely characterized the two collapses as isolated fraud cases. Yeah, okay. Rather than evidence of systemic rot. But again here, keeping an eye on this, and now let's go look at the other one here. So Jonathan Bach has resigned as co-chief executive officer of Blackstone Private Credit Fund, the largest non-traded business development company. The fund said last Friday. Bach stepped down from the same role at Blackstone Secured Lending Fund, Blackstone's publicly traded business development company, or BDC. Both resignations were effective July 20th. Brad Marshall, who has shared the chief executive title with Bach, will serve as sole CEO of each fund. His departure was not the result of any disagreement related to Blackstone or the fund's operations, policies, or practices. Both funds reported Blackstone Credit and Insurance, the unit that houses the firm's perpetual credit platform, thanked Bach for his service. In a prospectus supplement filed the same day, BCRED removed references to Bach as co-CEO and to Catherine Rubenstein as chief operating officer and replaced Marshall's title with sole chief executive officer. Rubenstein departed June 15th, making Bach the second senior CBRED executive to leave within roughly a month. Bach is among the most recognizable figures in the business development company sector. He joined Blackstone in 2023 as global head of market research for Blackstone Credit and Insurance and co-CEO of its two flagship BDCs. Before Blackstone, he led Barings LLC's business development companies as chief executive and held senior roles across several Barings credit vehicles. He built his industry profile earlier as a senior equity analyst at Wells Fargo Securities, where he authored the BDC Scorecard, a widely cited quarterly research publication on the sector. He holds a bachelor's degree in finance from the University of Illinois and is a member of the CFA Institute. BCRED has faced sustained redemption pressures throughout 2026. The fund met a then record 7.9% of shares in redemption requests in the first quarter, roughly $3.8 billion, by upsizing its repurchase cap to 7% and deployed about $400 million of Blackstone and employee capital. Second quarter demand reached approximately 10% of shares outstanding, which the fund prorated at its standard 5% cap. BCRED also cut its monthly distribution to 0 or 18 cents per share for July, its second reduction in 9 months. On its July 23rd second quarter earnings call, Blackstone said BCRED continued to see elevated repurchase requests, but that redemption pressure eased heading into the third quarter. So again, we now have claimed two executive scalps here in the private credit market. So Jonathan Bach resigns again as co-CEO of Blackstone. And over here, over here we had Phil Seng leaving BlackRock as the CEO of the firm's publicly traded business development company. So again, both guys running BDCs. BDCs are major players, business development companies, major players in the private credit world. So first two major executive scalps have been claimed here in the last month. Now, of course, the fact that this should have been front page news on the Wall Street Journal, the Financial Times, on Bloomberg. So Bloomberg did report on this. They just reported on it very quietly, for obvious reasons. They don't, again, because this adds fuel to the fire, right? This basically shows you that there are major problems going on in the private credit market, and they don't want you asking questions about this stuff. Because again, it's all good, right? It's all one-offs right now. At the same time, we had these executive scalps. We also had these companies rolling out new things. So Blackstone rolls out a new private market funds. This time they did it with Vanguard. So now they're partnering up with Vanguard to sell you this junk. I mean, really good investments. New offerings for individual investors follow exodus from private credit funds earlier this year. So everyday investors are getting more ways to access private credit assets. Yay! A new partnership between investment firms Blackstone, Vanguard Group, and Wellington Management is rolling out its first products for individual investors on Wednesday. One fund will combine public and private assets, and another will hold only private assets, including private equity, private credit, real estate, and infrastructure investments. The new limited liquidity funds come after an exodus of worried investors from private credit funds marketed to individuals this year, which prompted firms to cap withdrawals at present limits meant to prevent a fire sale of illiquid assets. Investors in the new funds will also only be able to redeem shares during quarterly windows. Yes. The key on this is that investors understand they are trading away some liquidity for access to things they couldn't otherwise get. Diversification benefits, of course, diversity, and most importantly, premium returns. It's like, I've got it. Oh my gosh, who's the comedian I'm thinking of here at the moment? Oh my gosh, why I can picture his face, I just can't think of his name. Gosh, of course it'll come back to me in a moment here. But again, you can see what's happening here with this, and that is that they want to, what does it say up here? One fund will combine public and private assets, and another will hold only private assets, including private equity, private credit, real estate, and infrastructure investments. So they're doing two things here. They are trying to commingle the private assets with public assets. Okay. And therefore, so what happens is when something blows up, then it makes it easier for them to come back and ask for a bailout, because they say, oh, well, wait a minute, it's not just the private assets, it's the public assets that are involved in this too. And you wouldn't want those public assets and those public investors going down, would you? So that's the one thing. The second thing is they're basically trying to sprinkle jimmies on a turd. Okay. They're basically saying, oh, well, we've got the private credit, but then we're going to throw in some private equity. We're going to sprinkle in some real estate. We're going to sprinkle in a little infrastructure investment. So don't worry about that underlying smell there. Just concentrate on the good jimmies and chocolate frosting we put on the top, because that's what's going to make this a dynamite investment for you. Like, it's just, it's wild, man. It's really wild. But you see what they're doing here. And then it kind of concludes here with like the tie-up between Blackstone, the largest alternative investment manager, and two big traditional asset managers represents Wall Street's latest push to get investments such as private credit, private equity, and private credit into the hands of individuals. That is not an accident. That is not happening by accident. They're doing that on purpose because they know that there are problems with a lot of this stuff. And they know that at some point they're going to be coming out asking for a bailout. And they're not banks. These guys are not banks. So when they show up and knock on the door of the Federal Reserve is going to say, "Well, you're not banks." And then this is the argument that they're going to use. They're going to come out to the public and they're going to say, "You don't understand. It's a domino effect. We're too big to fail. You can't let this go down." Yada yada yada. That's where they're going with this. You see that's where they're going with this. It's plain as day. And then we get to the next one. So Goldman Sachs is set to launch a private credit collective investment trust for the defined contribution market. So Goldman Sachs Asset Management today announced the introduction of the Goldman Sachs Collective Trust, the private credit fund. The GS Private Credit CIT, created by the Goldman Sachs Trust Company, is managed by Goldman Sachs Asset Management as the investment advisor. GS Private Credit CIT provides access to private credit investments for defined contribution DC plans through a structure built specifically for retirement portfolios. Yes, so defined contribution, that means your 401k. So again, on the one hand, you've got Blackstone basically trying to pump this to individual investors. And now you got Goldman Sachs. Basically, they want to get it right into your 401k. They want to pump this thing right into your 401k. The GC Private Credit CIT is designed to offer access to a broad mix of private credit investments by investing in funds managed by Goldman Sachs Asset Management, including North American and European direct lending and private placements, alongside a liquidity sleeve intended to support certain daily liquidity requirements. It will be available for use in professionally managed portfolios and solutions such as target date funds. That's great, isn't it? Isn't that what you want to get these people invested in? Multi-manager bond funds and other multi-manager CIT-based solutions, such as those used in managed accounts. So, again, getting to the retirement thing. I have been an advocate for people to have more options in their 401k, to have more control over their 401k. I mean, why not, right? If again, it's the irony here, the thing that has always set me off about the 401k is the fact that is this dichotomy on the one side, where on the one hand, the government's like, well, we're not giving people, corporations and the government are basically, well, we're not giving people pensions anymore. We're not doing that. You need to be responsible for your own retirement. Okay. You need to do that. But we're going to give you these tools, right? We're going to give you these tools like, 401k plan, to be able to save for retirement. We're going to give you IRAs, to be able to save for retirement, do a lot of it tax-free. And then that way, when you retire, you're at a different income tax, you're at an different tax bracket, you pay less in taxes, or so the theory goes. It doesn't always work out that way. But that's the general idea. But the thing is that the premise is on you to manage your own retirement accounts and your own retirement savings. But then on the other side of it, the government goes, well, wait a minute, you're too stupid to manage your own retirement savings. And Wall Street goes, yeah, you're too stupid. You need to leave it to the professionals. So then they want to dictate how you can use your 401k plan, what you can or can't invest in. One of my biggest gripes about the 401k plan is that I can't pull my money out of the market. And I know, wait a minute, I know I can already hear it. Some people out there are going, well, wait a minute. You can move your cash into like a trust. You could put it in a money market fund, right? Or like a cash money market, right? Yes, but it's still in the market. It's still in a cash. It's still in a money market fund that has the money invested in the market. No, I'm talking about a pure cash account. I want to be able to take my money completely out of the market and put it in a cash account where it's not in the market in any way, shape, or form. If I feel like the market is about to take a dive and I want to move my money to it's purely safe, like in other words, I don't have to worry about my money. Um, I don't have to worry about my money going up, but I don't have to worry about it going down either. And why not have a CD option in why again, banks use Intrafy. They use Cedars. They have these different programs out there for spreading around money into CDs so that everything gets you can maintain your $250,000 insurance coverage. So why not have that in your 401k? If I think the market's in trouble and I just want to take my money out and put it on the sidelines and hey, you know what? I'll tell you what. I'll put my money in it. And maybe the CD's only paying 2 or 3%, but you know what? That's fine. I'll just take my money out of the market. I'll throw it in a CD for 6 months or a year, and I'll wait till things blow over, and then I'll pull it out and put it back in the market. Why can't I do that with my 401k? I'm not taking the money personally. I'm not taking, but it's just that Wall Street wants your money to be in there all the time. Wall Street does not want you taking your 401k money out of the market and parking it on the sidelines. They absolutely do not want that. The other thing with the 401k is all the hidden fees that are in the 401k, and again, I know I'm getting off topic here. I'm getting off base. I'm going on a 401k rant, but I'm just saying these are some of the things that concern me. And while I'm an advocate that you should have more choices with your 401k in a certain respect, I think you should be allowed to take advantage of some of these things that other people are able to take advantage of, like IPOs, pre-IPOs, private placement memorandums for real estate, other things like that. I think you should have the ability, because in a lot of respects, these are the best investments, and most people are locked out of these investments because you're not an accredited investor in the eyes of the SEC. So, um, so I am an advocate for that on the one hand. However, I'm not an advocate for Wall Street peddling crap onto people and Wall Street peddling their crap onto people's 401ks as an off ramp, as a way to get out of, to basically say, oh, you know what? We know we created this giant turd in the private credit market, but we need to off ramp now. We don't want to suck up all those losses. We need to push this off onto the private to John Q. Public, and we'll do that through getting individuals to buy into it and by stuffing it in their 401k plans. No, absolutely not. I do not want this. I do not want this for anybody. I do not think anybody should be investing in this stuff in their 401ks. No, 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 no. And this is a big problem. And again, they're always looking to pass the buck. Okay, if the history of Wall Street teaches you anything, they're looking to pass the buck. They want to pass this off, and that is just horrible. That is horrible. It's wrong, and they just should not be doing that. But this is where we're at with the private credit market. So just to recap this real quick, to put a bow on this. Okay, we got two executives from BlackRock and Blackstone have bit the dust here on their business development corporations, business development companies, which are a big part of the private credit landscape. And then we have Blackstone along with Vanguard, rolling out these new private credit investments, and Goldman Sachs trying to roll out new private credit investments to stuff it into your 401k. So that's the latest and greatest on private credit. And like I said, I am not going to have any fun. Okay, when we get more blowups in the private credit market, and this eventually begins to hit people in their personal private lives, and their private investments, I'm not going to be the one to say I told you so, and I'm not going to gloat about it. It's actually it will be a very sad day for me to have to come back and report that news for you. But I know it's going to happen. But like I said, we'll see. But anyway, all right. Let's blow through the earnings here real quick. So we had four main earning reports. We had Apple, Microsoft, we had Meta, and Amazon, and their stocks were all over the place, depending on what they were reporting in terms of capital expenditure spending for the AI. So, first here, we have Apple stock slumps after a disappointing outlook. So, Apple shares fell 9% in early trading on Friday. After the company issued a weaker than expected revenue outlook, the company cited supply constraints in the face of soaring memory costs. Investors' attention may turn to leadership changes and the potential launch of a foldable iPhone in September. Then we go to Amazon stock surges as AWS, Amazon Web Services growth powers results. So Amazon shares surged after the company reported earnings far above analysts' expectations. Amazon Web Services revenue grew 37% to 42 billion, exceeding forecast by nearly $2 billion. Then we jump into Meta stock tumbles after its profits disappoint. So Meta stock dropped nearly 9% after quarterly earnings missed analyst expectations. Costs surged 55%. That is AI spending, as Meta invested heavily in AI and faced legal and severance charges. Meta shares are now about one third below their highs from last year. Then finally, we got Microsoft stock soars on solid fourth quarter results. So Microsoft shares surged after its quarterly earnings exceeded expectations. Analysts praised Microsoft's ability to balance revenue growth and margin and profit margins amid its AI investments. Maybe for the moment, we shall see. Then we get into here. So Meta's case for its AI spending keeps getting weaker. The all-out splurge is running into higher costs, borrowing constraints, and investor pushback. So Meta Platforms might not be the first big tech company to rein in AI spending, but the argument that it should be is growing stronger, as it should be for all these companies. Meta is the most financially stretched of the biggest tech companies. Its ability to generate returns from AI hinges almost solely on ad sales. And it has no record of building successful businesses beyond its core social media franchise. Yes, Meta has, remember the metaverse? Remember all this stuff that they tried to get into, which just blew up in their face? So those flaws are coming into sharper focus as AI spending boom pushes into overdrive. Meta is anticipating capital expenditures of around 137 billion this year, a total that analysts expect to put it into negative free cash flow territory in the latter half of the year for the first time since its IPO in 2012. The company will likely fall deeper in the hole next year when projections via FactSet suggest it will burn through another 20 billion in cash. And look at your free cash flow here. Now, remember last week I reported on Alphabet, and Alphabet shares, that's Google, Alphabet shares took a nosedive because their free cash flow, their free cash flow went negative because again, their AI spending. This is not good. So, excuse me for a second there. Um, again, and this shows you the recklessness of these companies right now, because what they're basically showing here, what they're telling you is that they're all in this race to be first, and they're basically all they're all playing this game of chicken, and it's it's crazy to watch. What they're signaling here is that they're all playing chicken because they all want to be first in the AI race. But the big question is, what does that mean? How do you define finishing first in the AI race? What does that look like if there are constantly new models coming out all the time, if the pricing is dramatically under pressure because it's becoming commoditized? What does winning look like? What does being first look like? I mean, the right now they all look like Velma and Louise. They all look like they're in the car and they're just driving. They're like, look. I mean, look at the chart there. Look at these numbers. This is Velma and Louise. They're all in there and they're just driving their car right off the cliff. And they all look like they're all willing to completely wreck their companies in order to finish first, become number one, like whatever. I don't know. So again, you see this absolute drain from the AI spending here. Um, Investors have given big tech a long leash to invest in AI over the past few years. That made sense given the capital intensity of what looked like a potentially world changing boom. But shareholders' patience is being tested like never before as tech giants take AI ambitions to the next level, even as the cost of computer memory and other AI infrastructure components rises. Meta stock fell 10% in after hours trading Wednesday after it raised the midpoint of its 2026 capital spending range and fell short of Wall Street's second quarter profit expectations. Of course, Meta isn't the only company that is bleeding money to fund AI. So are Amazon and Alphabet. Google parent Alphabet stock fell nearly 7% last week after its earnings included a 10 billion hike in capital spending for this year. Yes, so again, it's just crazy to watch this. Then we go into signs of strain could be emerging in the AI spending boom. Health of the AI spending boom could also influence the U.S. credit outlook. Really, you think? So this is now we're shifting from the AI. This is shifting from the AI conversation to the AI from the companies themselves to the trade, the overall trade, the strategy. Like, okay, we've gone all in. America has gone all in on the AI trade. The government has gone all in on the AI trade. And now we're really begin to see these strains here. So cracks, and let me make this a little bit bigger. So cracks in big tech's artificial intelligence fueled spending binge could be reforming across stocks and bonds. Wall Street was displeased last week when Alphabet and Tesla Motors raised their forecast for capital expenditures known as CapEx for the rest of the year. While market watchers await spending updates from other AI hyperscalers as they release their latest earning reports over the coming weeks, total CapEx in 2026 is expected to reach up to $1 trillion. I mean, it's just unbelievable. And I had reported on how the bond market a couple weeks ago. I reported on how the bond market was straining to absorb all of this, the money being funded to get for all this AI funding. Then we go to big tech stocks are pricing in a miracle on costs. So analyst models are assuming new efficiencies, but some of the numbers look too good to be true. So here's the other part of it. You have like all of this is going south at the same time. You've got too much in tech spending that's wrecking the finances of these companies. They're going to have to cut back the tech spending. The AI has not delivered on all the efficiencies it promised. You now have a price war that has broken out that we're going to see in just a second. In the they're everybody's now OpenAI and Anthropic. They're racing now to drop their prices because people blew through their tech budgets. They didn't get what they needed, and now they're looking for cheaper alternatives, and they're looking at some of the Chinese AI, and that brings its own issues with it. But so this is what's happening. You're beginning to see all these cracks forming around pricing as people are viewing this more as a commodity. It's commoditizing. So, but let's look at this for a second. So, Wall Street forecasts for big tech require a major leap of faith that the biggest AI hyperscalers can boost revenue much faster than the costs of running their businesses. Some of the numbers look too good to be true. Investors are already on edge about the company's soaring capital expenditures related to artificial intelligence. Again, you could see the cash. I mean, look at the cash burn here. Look at where we're at. Almost three quarters of a trillion in 2026, expecting to go to 1.7 trillion by 2029. And then your free cash flow going down here. We're already negative free cash flow. By the end of this year, we're already negative. And they're expecting it to go negative, but then they're expecting this big bounce back up, but that remains to be seen. That only happens if AI can actually deliver on what it's promising. Then we go into dwindling cash and soaring memory costs. Tech's AI build-out has ballooning price tag. Yes, absolutely. So Amazon, Alphabet, and Tesla are reporting negative cash flow in the latest quarter, while Meta's cash generation plummeted by 91%. The AI build-out is having a massive impact on corporate balance sheets, and costs are going up even more than expected because of the memory crisis. Apple issued a weaker than expected revenue forecast for the current quarter due to supply constraints that are forcing the company to raise prices. Yes, exactly. So this is all coming in at the same time. And the big worry here is that basically you cannot get the AI efficiencies to the point you need it to get to, and that basically this whole trade effectively blows up because they have to cut back the spending because their cash flow's all gone negative. They burned through all their cash. They need to reverse that, so they have to cut back on all the spending. That slows it all down, and at the same time, you got to cut prices. And the AI models, the business models of Anthropic and AI proved to, if they prove to not be profitable, then like I said, this whole thing can go sideways here in a very big way. And here you go. OpenAI cuts prices for two of its GPT 5.6 AI models as companies grow sensitive to costs. OpenAI announced it is slashing the price of two of its latest artificial intelligence models, GPT 5.6 Terra and GPT 5.6 Luna. The company said it is reducing the price of Terra by 20% and the cost of Luna by 80%. The company is facing pressure to cater to a more cost sensitive customer base and fend off competition from Chinese startups and other tech giants. Yes, absolutely. So, again, this is a big problem here for these companies. Then we get into NVIDIA and OpenAI are in talks for up to 250 billion backstop to fund AI infrastructure plans. So OpenAI is in discussions with NVIDIA about a backstop of up to 250 billion that would help fund its plans to lease a new AI data center, CNBC has confirmed. The backstop would let OpenAI raise debt for a 10 gigawatt data center campus in Pike County, Ohio, on the strength of NVIDIA's credit. The talks about the site and its financing are in process and still subject to change. Now, here's a very interesting thing. I was watching a podcast of people this week on the whole AI, this whole conversation around cash flows and investment. And the very interesting thing, and why I think the NVIDIA, basically looking to give OpenAI 250 billion to backstop this infrastructure. What makes this so interesting is that their hypothesis that they were working with in this conversation was that OpenAI is the key to this whole basically this whole AI ecosystem, if you will, and that basically if OpenAI goes down, it will take the entire AI ecosystem down with it. And so that's what makes this investment by NVIDIA so interesting. And again, we will see how this, again, we'll see how all this plays out. Now, on another front here, this was very interesting. So again, what did we hear? What did we heard all year? Oh, AI is going to take all the jobs. It's going to wipe everything out. We have no way of, this is just what's coming. And then what happened here? Companies blew through their AI budget. AI did not deliver on all the efficiencies that it promised, all the revenue that it promised, all the income streams that it promised. So far, in a very real way, it's proven to be a big dud. And so what do companies do? What are they doing? Oh, wait a minute. They're hiring again. Big companies are starting to hire again, defying predictions of the AI wipeout. After a year of holding back on new hires, companies from tech and transportation to defense now say they need more people to work alongside AI. Oh, I call me shocked. So America's biggest companies say they might need more people after all. For months, major employers treated hiring as an expensive last resort. Now a shift is emerging across industries. Companies ranging from railroad giant CSX to Google parent Alphabet have told investors in recent days they plan to hire to meet growth goals or to seize on emerging technologies. The push to expand headcount, at least modestly, is a reversal from the prevailing corporate messaging during much of the AI era. Major employers largely held back on adding people due to economic uncertainties or a belief that artificial intelligence could shoulder more tasks on the job. But some executives say the costs and limitations of AI now demand that more people be added. Others want to hire people back following layoffs. We actually need to accelerate hiring a bit. We're a little bit behind right now. Booz Allen Hamilton's chief operating officer, Kristen Martin Anderson, told investors Friday, we're addressing that now. So very interesting. So then So now we're going to get into the AI runs wild here for just a second. So two articles here on this. So new details in the OpenAI Hugging Face hack show how far agents will go. It's now remarkably easy. So OpenAI has shared additional details about how its models independently breached Hugging Face's internal systems. The models used publicly exposed credentials across 4 accounts on 4 services to help facilitate the attack, the company said. OpenAI said it has not identified any other activity at the level of severity or scale of what we've shared related to Hugging Face, which involved a platform level compromise. So, again, this story was just fascinating because the OpenAI program here basically just went out. It did all this on its own. It went outside and came back in, found credentials to access these 4 accounts on 4 different servers to basically attack Hugging Face, which was a company that the AI was supposed to be working with. It was supposed to be working with this company, and this is this is wild. And then we go into Anthropic says its Claude AI model hacked systems of 3 organizations during safety tests. Anthropic made the discovery after reviewing 141,000 evaluation runs in which Claude could have obtained internet access. So Anthropic said on July 30th that it had discovered instances in which its artificial intelligence model Claude gained unauthorized access to the systems of 3 organizations during cybersecurity testing. The company said in a blog post that it made the discovery after reviewing 141,000 evaluation runs in which Claude could have obtained internet access. Anthropic said that in the 3 identified incidents, Claude accessed the internet from within or while interacting with the evaluation environment of one of its third-party evaluation partners. In all cases, Anthropic's evaluation prompts specified to Claude that its environment was a simulation, that it had no internet access, it stated. So again, this is just wild. And again, it gets back to the other element of this whole AI thing, and that is around rules around AI and guardrails around AI. Something that I have been clamoring for months and months and months, basically saying that some of these systems are becoming far too dangerous. It's moving too fast and becoming too dangerous. And some of this we have to rein this in. The government has to put guardrails around this AI. Now they seem like the government seems like they are finally slowly getting this message here, but we're getting there. But it needs to move faster. It needs to move faster. The AI guy, the tech bros aren't slowing down. So this definitely needs to move quicker. So, all right, now, and then I think this might be my last article here on the AI thing. So a backlash against Anthropic is brewing in Silicon Valley. No shocker here. The AI pioneer faces growing distrust from startup founders and researchers over competitive tactics, guardrails, and lack of support for open weight models. Yes. These guys are running wild. And again, it gets back to the whole Silicon Valley motto: move fast and break things. That's their world. That's the world they live in. Are they bothered by messing a bunch of people up? No, as long as they again perceive themselves to be finishing first, then the ends justify the means. So we have a backlash against Anthropic is brewing in Silicon Valley, rooted in concerns around the company's product launches that compete with existing software providers and its advocacy for a closed AI ecosystem. Startup founders, software company executives, and other AI researchers said they began turning to cheaper AI models after seeing Anthropic release tools in the market that compete with those offered by other companies. One such release was Claude Design in April, which some saw as a direct competitor to offerings from design company Figma, one of Anthropic's partners. At an event shortly after the release, Figma chief executive Dylan Field said Anthropic hadn't been consistently candid in their communications. The whole industry learned a lot of lessons from how that dynamic played out. So very interesting there. And again, no shocker, and we'll keep an eye on that. Now, some of the nuclear news that's going on here, which I thought was wild. An underground nuclear reactor is coming to this Kansas town and dividing locals. No one has tried operating a commercial one a mile down. I don't know. Until now, it's great that it's here. It's kind of bad that we're the guinea pigs. So, residents of this sleepy farming outpost agree on many things, but whether to put an experimental nuclear reactor a mile deep in the granite beneath their town isn't one of them. Elected officials and some others see a chance to create jobs and lure data centers and manufacturing to a rural patch whose community has been flatter than the surrounding cornfields. Another group is effectively saying, not under my backyard. Yeah, I mean, it's wild. So they want to put this new experimental nuclear facility 1 mile under the ground. So again, very, very interesting here. And this is out in, again, out in Kansas. And then we have this inside the next gen nuclear power revolution in Idaho's high desert. So high tech developers and hyperscalers are financing a nuclear renaissance and will mass produce portable reactors, not next decade, next year. So this is fascinating. Looking at this, the NRIC dome over here. So Idaho Falls, Idaho. History was made with the flip of a switch at 12:30 a.m. on June 4th under partly cloudy skies and a waning three-quarter moon in Idaho's Arco Desert when a prototype reactor sustained a nuclear chain reaction, becoming the first new design to achieve criticality or viability in the United States since 1973. In that midnight milestone wake, the future is following fast since Antares Nuclear's Mark O design was validated in early June. Three other novel reactor designs have met the U.S. Department of Energy's critically requirements, and according to Energy Secretary Chris Wright, up to four more could do so by year's end. While technologies, fuels, and applications vary, these prototypes share common traits. All are far smaller than the conventional reactors with massive cement cooling towers, and all are designed to be mass-produced, portable, and scalable. Several can fit in the bed of a pickup truck, like what we're looking at right here. This is kind of wild. The nuclear energy surge is a convergence of rare bipartisan accord with stymied science and spiking electricity demand spurred by power-hungry data centers and the integration of artificial intelligence and quantum computing into the electron-dependent world where the average U.S. home has 21 digital devices. And they're saying that this might happen by, next year. This is actually 3 Mile Island up by Harrisburg, PA. But again, this is really interesting developments here. And then I have this final thing. Basically, developers say that more federal state lawmakers needed to sustain the U.S. nuclear renaissance. So industry cheers the Trump administration's deregulation and spurring the first new reactor validation since 1973, while lobbying for faster licensing and state reciprocity. So yes, so we'll have to keep. Again, we'll have to keep. So I thought some of these developments were really fascinating. We'll have to keep an eye on this to see what happens here. Now, some of the things I'm going to blow through real quick. Robinhood, they announced this platinum credit card. They apparently are doing a revamp of this now, offering it at $6.95 platinum card after customers take issue with some of the perks. The trading apps card announced in March aims for higher end users looking for rich rewards. And obviously they got into the reward cards environment here against Capital One Venture X, the City Strata Elite, so on and so forth. So again, still finding their way there. And then prediction markets race heats up as Robinhood and Crypto.com hold talks. So the deal could put the brokerage firm in more direct competition with Kalshi. But again, Robinhood has made no bones about the fact that they have tried to move in to the prediction markets. And this is their next move. So Robinhood Markets might have found another dancing partner in the prediction markets business. The company is in talks with digital currency exchange Crypto.com to expand the brokerage firm's foothold in prediction markets. according to people familiar with the matter. Robinhood so far has relied on Kalshi and others to supply betting contracts for its predictions platform, but what began as a partnership is evolving into direct competition as the two companies push onto each other's turfs. So yeah, so we'll keep an eye on that and see how that unfolds. Couple interesting things on the Epstein front here. One of the key people, this modeling scout with Epstein, with ties to Epstein, of course, found dead conveniently. French prosecutors are investigating the death of Daniel Syed, who scouted models for Epstein. He had a lot to say, never got a chance to talk, and now we'll never know. And then finally, you had Kathleen, a Rumler, basically blaming, the issue on other people. I've said before, I think it's gross that Goldman Sachs still has her employed and still has her there. I mean, it's ridiculous. You also had Jez Staley, who, again, former JP Morgan guy who was, I think, over at Barclays, and he got fired. Another disgusting individual involved in all this, who was basically, Jez Staley was one of, Epstein's basically private bankers. But yeah, just the fact that Catherine Rumler is being allowed to stay on here at Goldman Sachs is just, it's gross. It's really gross. And she literally tried to blame a dead victim of Epstein here, as this was all on her. This was all her fault because she lacked credibility. It's like, I mean, are you for real? Just unbelievable. So anything. All right. I don't really have the chance to get into these articles here on the auto industry. I just going to touch on this real quick. I'll probably try to have to save some of this for next week, but Tesla weighs sale of their China business to pay the way for a potential SpaceX merger. That's interesting. We'll have to keep an eye on that. Trump is taking on the right to repair, but what does that actually mean? Like right now, Massachusetts and Maine are the only two states that currently have comprehensive right to repair laws for car owners. So we'll have to come back to talk about that aspect of it. Canada is welcoming in these Chinese cars, but here's why that matters for America. The cars cannot be sold in the United States, yet Canada's open door threatens American jobs and data security, analysts say. Again, these new Chinese electric cars with their AIs in it could be doing some funky things here. And then finally, General Motors basically is launching a proprietary in-vehicle AI system later this year. So General Motors plans to launch a proprietary in-vehicle artificial intelligence system that is better tailored for its customers later in the year. So yeah, so we'll see how all that goes. But oh man, that was a lot to get through. But that is all I got for everybody today. I'm going to go into wrap up mode here, and we're going to do our story of the week and our quote of the week here in just a second. But before I do that, where are my banners at? I got to find my banners here for a second. So okay. If anybody is watching the podcast on Apple Podcasts or Spotify, please be sure to leave me a review. Could really use the reviews over there. That could really help the channel. So if you are listening to this on Apple Podcasts or Spotify, please leave me a review. Make sure to visit thebankernextdoor.com. Got a lot of great stuff up there on the website. We'll have more updates coming on that in the following months. Make sure to subscribe on YouTube. Like, for example, what happened today is a perfect example. Usually we do the live stream on Saturday nights at 8 o'clock. That didn't happen. I had to push it back to today. And then originally it was going to do 11. I had to push it back to 2. So life happens. So again, but if you want to get those latest and greatest updates on what's going on, make sure to subscribe on YouTube. And you could get, like I said, I put all those posts up there. You can see what's happening. If you would like to send questions, comments, topic recommendations, anything like that to me, you could send it to info@thebankernextdoor.com. That's how you get in touch with me. Please be sure to send me your emails. You could follow me on social media at Getter, X, and True Social, although I will tell you I spend the most of my time on X. And again, BND Strategy Room, we are on YouTube, Rumble, and all major podcast platforms. We have new episodes that come out every Monday through Friday at 12 noon. And then we have the BND live stream every Saturday night at 8 o'clock here on YouTube. So, woo. All right, now let's get to our story. You know what? Hang on. Let me do one thing here. Okay. So our story of the week, we are getting into direct public offerings known as DPOs. So, a direct public offering is a type of offering in which a company offers its securities directly to the public to raise capital. An issuing company using a DPO eliminates the intermediaries, investment banks, broker dealers, and underwriters that are typical in IPOs, and self underwrites its securities. Cutting out the intermediaries from a public offering substantially lowers the cost of capital of a DPO. Therefore, a DPO is attractive to small companies and companies with an established and loyal client base. DPO is also known as direct placement / direct listing. So the direct public offering DPO is your story of the week. So now we go on to our quote of the week. So our quote of the week comes from legendary basketball coach John Wooden. So don't measure yourself by what you have accomplished, but by what you should have accomplished with your ability. I love that quote from John Wooden. Don't measure yourself by what you have accomplished, but rather by what you should have accomplished with the ability that God has given to you. So, all right, that is our show here for this week. I thank you so much for joining me on the Strategy Room. I can tell you that this week coming up, I've got some things going on. So the live stream will be on Friday night as opposed to Saturday night. I'll post that notification up in the next few hours. But like I said, just thank you for joining me here tonight. I thank you for being here and hanging out in the Strategy Room with me for a couple hours here on a Sunday afternoon. Have a great week out there. And like I said, I'll see everybody back here real soon. Thanks a lot and take care.